This is going to get really technical, but if you're tired of getting stopped out right before something runs, give me a couple minutes of your time. All right, this is Spooky's Revenge. We're back with another episode of the 5 years, $500 Rags to Riches series, and today I want to walk through probably one of the biggest obstacles most technical traders run into over their trading career, and that is getting stopped out all the time, just constantly. It's frustrating. It costs a lot of money. It feels annoying. It feels like the market's picking on you, and that's because it is. So let's go ahead and get my face out of the way. And I'll walk you through a couple trades that we did on the live stream this morning, and I just want to walk you through a concept, and then you can apply that to hopefully save yourself some money. So I'm going to get my entire face out of the way on this one, only because I need that real estate on the screen. So first and foremost, we need to take a reasonable, common sense approach to our trades, and that involves using multiple time frames. First off, right? We know that the higher time frames represent more data. It's more stable price action. Longer is stronger. This is where most people tend to find success. Because the higher in the time frame you go, the more reliable the technical analysis tends to be, the easier it is to spot reversals, support and resistance levels, and all that good stuff. So if you're a newer trader, this is where you're going to want to spend a lot of time. If you've been around the block for a while and you're running into that pitfall of just, you want to make more money faster, or you want to stop hurting yourself, but it seems like you just keep getting stopped out before something runs the same direction and hits your target anyway. Let's take a look at why that's happening. So on the higher time frames, you've got institutions, right? This is the bigger banks. They're the ones who decide when the price turns around, where it turns around, how far it goes, all that stuff. It's not us. I don't control the price action. I'm just along for the ride. So as traders learn how to do technical analysis, they're taught, draw your trend lines, wait for confirmation off that trend line, wait for the setup to fulfill. You get your confirmation. You've got good volume. You place your buy if it's a reasonable risk. You seek an appropriate reward, and you scale out of your position responsibly, and you should make profits, right? But why is that so hard to do? A, psychology. That's 90% of it. If you can't learn how to get out of your own way and follow the plan you set up for yourself initially, it's going to be hard. The next part is execution. If you're not familiar with your interface, if you use the wrong order types, or you're not aware of things like the wash sale rule, PDT rule, other restrictions, the type of exchange you're on, if you can't trade like crypto, for example, and you're trying to trade crypto, you're going to have a very hard time. And then the other small piece is just analysis. And most people actually knock this out of the park because they spend a lot of time focusing on it and they don't give themselves enough credit when they're right. They only give themselves credit when they're wrong, and it comes in the form of self-punishment. So, as an institution or as a bigger bank, if you're looking for the price to continue in a direction, you have to know which direction that's going to be, and you have to know why it's going in that direction. We don't determine that. Our job is to identify the food chain, right? So as a retail trader, as a brand new trader, okay, your job is going to be to ideally buy very small risks, set a stop loss immediately, let the price breathe to the upside to an appropriate target, and lock your profits. Okay, that's your goal. You're buying a very small amount of shares in the grand scheme of things, so it really doesn't matter when you get filled. You can kind of buy up and down all day long, right? However, if I move this over to another chart, I can just kind of draw this out, right? Say we got a level right here, support level, okay? If you're looking for engulfing candles like this, your entry would be here, your stop loss would be here below this level, and your target would be somewhere up here, okay? If the overall trend was to the upside, let's just say we want the trend to go up, okay? And I'm an institution, and I also want the price to go up. What do I have to do to participate? I can't buy 100 shares and be okay with that. I need to make money for my brokerage. My boss would kill me if I was an institutional trader and I only traded 100 shares. So what they have to do is they have to find zones of liquidity, or where shares are available, okay? And if there aren't any available shares, they have to make them, okay? So what this results in, let's say we're trading a higher high and a higher low situation, and this is our trend, right? We're trying to get in right here off the support as it validates. We got a nice defined risk right here. We have a defined target, and we want the price to go, okay? That's a retail job. As an institution, I can identify this. I know exactly where people are going to be buying, and more importantly, where they're going to set their stop losses. This provides a zone of liquidity. Okay, this is sell side liquidity. This is where people are going to sell if the trade falls below this low, below this support level. All right, so this is where I'm going to buy those shares that other people are panic selling or cutting because the low has failed, so that I can then release the price to the upside and it can go up and we can all make a profit, except for the people who sold me their shares. So that's it. That's the food chain. Now, our job as people who are above this are to identify those two sides and identify where retail is likely to jump in. And this is called an inducement. It's when there's a tempting opportunity in the market that makes sense for most small traders, and they're likely to trade it. That's an inducement. Okay, we can trade those. We just have to be very careful and very tight, especially on lower time frames. Now, as a retail trader, as an institutional trader, your job is to exploit these. And that's why you typically see the price do something like this. It'll go up a little bit, it'll slam back down, hit your stop loss, and as soon as you sell, the price blasts and it goes way higher, right? That's because the hedgies, the institutions, are loading up right here. They're taking your shares that you bought, you're selling them to them here, and then they're taking those and riding them up into the heavens. Okay, so let's break that cycle and identify where they're at and why they do it. All right, so this is the 1 minute chart. It's what we traded earlier today on the live stream, so I'm not going to go through all the specifics of it, but basically, market open happened right here. We kind of identified from the higher time frames that the price was likely to pull back. That's where I would want it to go as a hedgie. So if I turn off extended hours here, you can see we had this inefficiency, this indecision in the market, and then we had the pullback, right? So we had a small candle body. We understood that there was likelihood of it selling off. We had a little bit of rejection up here. And then all we had to do is understand that we have a gap down here, we have a strong level here, and we have the potency for it to pull back into a retracement. Okay, so on a higher time frame, this was bearish. And it's Disney and it sucks, so it's just bearish anyway. I hope they don't get my video banned for saying that. So for education purposes, Disney is not my favorite stock. All right, so when the market opens, okay, we don't have to try to trade the first like 10 minutes, right? That's chaos, all right? All we have to do is identify where the price turns around. And we did this on the lower time frame as well. So we went from the 4 hour down to like the 15 minute, I believe I was on, just to identify the confirmations and stuff to make sure the price was going to go the direction that everybody wants it to go, right? Believe it or not, institutions want the price to go in the same direction we do. They just do it a little bit differently so they can participate. So all we have to do is just not get in their way. All right. So when the price shot down and then bounced back up, okay, this is institutional support stepping in. They're saying, okay, I want to buy some shares right here to control the price. Okay. And then when the price pushes up, it retests this zone. We had another area because right here, okay, this is a sell side liquidity zone, right? So this means that when people, when the price hits here, there's going to be selling. All right, there's going to be selling no matter what when it hits this level. You've got stop losses here. You've got bearish continuation. It doesn't matter, right? It doesn't mean we can't go long or we can't go short. It just means that when price gets in this zone, the selling will start, okay? And then once it hits this zone, buyers bought and they push the price back up. Institutional buyers bought, the banks, okay? That pushes the price up out of the zone and leaves this liquidity zone right here below everyone's stop loss, right? They have their stop losses set right there. So when it comes down here, those stop losses trigger, sells execute, and then the opportunity for them to buy steps into the equation, right? So in this case, the price didn't go, right? They didn't defend this position. So they're just slowly accumulating shares. They don't have to defend every single one. Our job isn't to try to catch every single one. It's to identify the ones that aren't resolved, have strength, and then have a confirmation, okay? So after the price pushed up, it pushed down, it revisited that same area, and then it pushed back down again, down to this area, and then it pushed up a little bit. It didn't have a confirmation. There was no strength here, so there was no bullish trade. But we did have another peak right here. It's a little hard to see on the screen, I'm sure, but this is another liquidity zone right here. And if we look at the volume, it's very low volume, so I just changed the width of this shape to very thin, so that shows that it's a weak level, okay, or a weak zone. This level here is very strong. This level down here is very strong. If we look at that gap, we've got a liquidity zone right here, right? Because everybody's stops that bought here should be right here on the inside of this gap. Okay. So up here, you've got buy stop orders from the shorts that want this price to go down. Down here, you've got stop loss orders for longs that want the price to go up. So it's just a matter of which ones the hedgies are going to take and when they're going to take it. All right. So in this case, the price went down, down, down. We came down here. We formed a liquidity zone right here. And this is the one that we talked about on the live stream. We called it. I wonder why this price isn't scaling. There we go. So it touched this liquidity zone right here into the gap. We called it on stream. And then we had a strong push up here and then a higher low. And then it pushed up into this previous liquidity zone here. This one here was resolved right here when the price pushed up through that. So that was invalidated. It was compromised. There's no bearish entry there. And we knew that the likelihood of this trade, the higher time frame wants it to go down, remember. So this was just a short term, we had a little bullish engulfing here up to this previous high right here. And then we had a this liquidity zone right here got in the way. So we identified this as a high risk and determined not to take that one. Even though it hit target, it's still just safe to identify the high risk and just maybe avoid those. But overall, we knew that they wanted the price to come up into this liquidity zone or this one here. And then the likelihood of them slamming it back down from this zone for a bigger move was much higher. And that's what we were after. We weren't after these little push-pull stuff, this chop, okay? So this is a nice little beautiful double bottom setup. And this is an inducement, remember, because long traders want to trade double bottoms. They want to trade to the upside after this level is broken. Their stop losses are right here. So this is an area of liquidity that was reinforced after this level formed. Okay. So remember, if we're an institution, we know that people are going to buy here. We know their stop loss is going to go down here. We want these shares or we want these shares for shorts. Okay. Since we're going to the downside on the higher time frame, we want to look for those short liquidity zones on the buy side. So up here. Okay. So basically all we had to do was wait for this zone to get tested, which it did, this liquidity zone here, and then a confirmation out of that zone on color change right here. That's where we took the entry on the live stream. We put our stop loss up here, obviously. And then we knew that there's another liquidity zone down here. And we also formed a bunch of little ones on the way down here as these new lower highs formed. So these were unresolved. They didn't have any prices breaking over them. All right, so here we enter that bullish liquidity. All these stop loss orders hit for the gap. Bulls bought it into another inducement. Remember, our job isn't to trade like retail. Our job is to trade in a predatory way towards institutions, which are predatory towards retail. Okay, so it's a little bit of abstraction there, but we want to take advantage of the fact that institutions are trapping retail. Okay, and all we have to do is just look for these liquidity zones, just where people are going to put their stop losses. We know where they're going to enter most of the time, right? We know this is a double bottom setup. We know there's color change entries. We know there's level break entries. It doesn't really matter. We know where they're going to put their stops, and that's what's important, okay? Because then all we have to do is look for those zones where those stops are and make sure that we have an appropriate approach to it. And then once we see that confirmation, once we see that the institutions are actually trading it in that direction, we know that we can hunt new lows or new highs if we're going to the upside. So in this case, this price went all the way down to 86.94. Just in this series of lower highs, lower lows. And if we look at that on the 5-minute time, or sorry, the 15-minute time frame, it was just straight impulse. There's just lower candle, lower candle, lower candle. So there's a lot of noise on the lower time frames, but it's nice and clean on the top sides. And it was just in the direction that the higher time frame wanted to go anyway. All right. So remember, the summary here is that institutional traders, so big banks, they have a lot more money. And it's harder for them to get filled. They need the price to come back to certain areas so that they can fill. They can get all their shares, and then they'll release the price in the direction that it wants to go anyway. All right. And here we saw this situation happen. We had a little bounce here, and this is an inducement right here. Okay, we had a double top. We knew that the bulls were going to join here, okay, on the break of this level. And we knew that their buy stops were going to be down here. All right. So in this case, we never came back to that level, which tells me there's a liquidity zone right here. For the next time we come back to this area, we can look for those institutions to show a confirmation that they're buying these shares and then push the price back up. Okay. So the Disney one was pretty clean. It was pretty easy to trade. Let's look at SPY. That was the next one. We get the same thing. All right. We get a higher time frame here. We had a push. And then we knew that we were overextended to the upside and we were likely to come down. So that's what we traded. We looked at the 15-minute, identified some some stuff. I have a bunch of extra lines on here. We can erase those. Don't really care too much about those right now. What I'm interested in here is the pullback, right? Because again, we want the overall time frame here to show us what to do. I think I was using the 30-minute on this one. No, maybe it was a 5. I think I was on a shorter time frame for this one. I can't remember exactly what it was, but the overall setup here was just this little pullback, right? So we know we had higher highs, higher lows. We had a liquidity zone right here, right? It was invalidated. Obviously, it pushed all the way through. We knew that we had a liquidity zone up here, and this was just a nice, beautiful buy-side sweep. I'm sorry. I lost track of what I was saying there. So if we look right here, for example, there to there, okay? And the sizing is relevant to past price action and volatility, so we'll get into that in another video. But you can see that we had a high, okay? The price pulled down. That establishes liquidity zone right here, okay? More importantly, look at this volume. That's what matters, okay? And then right here, we're in this liquidity zone. We're starting to push back down. All we had to really do was look for a color change, right? So if we're here on this chart, it looks a little bit more expanded this way. You know, if we want to take a bearish trade and everything is telling us in the moment to look bearish, I know it looks bullish after the fact because the price shot up afterward. But all we had to do was trade it down to this level right here. Because remember, if we get an impulse, all right, and the price pushes back into that zone, that's where they're going to get filled. So we watched this in real time and we saw the flicker and the flutter in the candle in real time. I think that might be recorded in the stream, so you guys can go watch that as well. But that's what we were looking for. We're just looking to identify where the institutions were trading. We knew the direction they wanted to trade, and we had a predefined trade based on what they were doing and what they were looking for right in front of us the whole time. All we had to do was seize that opportunity, and knowing that when we see a sweep like this, a buy-side sweep, it usually hunts the local low, the low that failed to push lower. This becomes hunted. It has draw, okay? So in this case, we hit the target, and then we just kind of pulled up after that. So we never hit the second target down there. That's okay. We locked the bulk of it here at the first target, and then the little piece that's left running can go wherever it wants. We don't care because we get net profit. All right, so in this case, we just had a blast. It's just insane. So let's look at Tesla, because this, I think, is a much cleaner description, right? So if we look at Tesla, we can see that we had the strong impulse to the downside. This is on the 1 hour time frame. Let me kick it up to the 4 hour. We had a big push, fib retrace, a push to the upside. Okay, so we're going to look for a bullish move. All right, so here's the market open. Somewhere around here. I think it's right here. Sorry, took me a minute. All right, not going to trade the first few minutes. I'm going to look for where people are going to enter and where they're going to put their stop losses. So right here and right here. This is invalidated, so we can erase it. This was created, so we can draw another one till it's invalidated. That's a liquidity zone. All right. So we knew also that we had the higher time frame one down here. Sorry, on the 4 hour chart. So that's the liquidity zone we were using as our bottom. Price came and dipped right into that. We saw it getting bought up in real time. Very easy to identify. Came back, touched that. We got that long entry, and the price just went up. And then we had another double bottom right here. Same thing. It formed a liquidity zone, and the rest of them were drawn, but they were invalidated throughout the morning because they just kind of cancel each other out and keep pushing. But really what we're looking for is the rejection inside of a liquidity zone and then a break back above it. And that's what we were looking for, and that's how we got that beautiful trade. I did take an option contract, and I was stopped out by 1 cent before it ran. Let's go ahead and look at the chart on that one because it's funny. It was November 17th, 227.50 calls. It was these guys right here. And you can see I entered here, got stopped out by 1 cent, and then it ran all the way up to well beyond my second target. So easy trade. I missed it by 1 cent because I got the wrong fill in the contract, and there were 41 contracts I think were filled. So if there were members that did trade that, maybe they didn't get stopped out, maybe they did, but why risk it, right? Okay, so we've got this liquidity zone here. We've got a liquidity zone here that's invalidated, unless you're trading it short term. But we ultimately came back to this one, and this is what we care about, the volume, right? We care about the volume at these levels, and more importantly, this rejection followed by an engulf to the upside, and it just blasted all the way up through, and then we got channel locked. And if we look at the higher time frame here, we can see it's just the same. It's more of the same. So we've got buy side, sell side liquidity sweeps, and it just kind of bounced around. And Monday, we'll get our clean break, ideally, right? We should see a break on Monday. But every time we had these lows, we had a sweep, right? So if you draw this right here, I'll just erase all these. Okay, so if I draw a zone right here, okay, and then the price comes back here, and then we see a wick and then a push, and we get that color change, that's an entry opportunity right there. That's an entry opportunity right here. This was the good one because that was much stronger volume. We got this side right here. I'll draw them the same size. There we go. So, you know, maybe this would have been an opportunity for retail, but we know that there's no institutional participation, so we can pass on that, right? And since the price broke above it, that zone's invalidated. This then becomes the next liquidity zone, right? And then we also have one right here for potential buys. And remember, these are just areas where the institutions are looking to see where retail is likely to buy so that they can place their stop losses and then take their shares. So in this case, this was invalidated, so we erase that. This then becomes the next liquidity zone because people are going to buy this, right? So if I draw this out as a retail trader, this is what I would look for. I have a nice tiny engulfing candle right there. I set my stop loss right there. I set a 1 to 2 target. That's my trade as a retail trader. So I know this is where retail is going to look. So as an institution, I'm going to look right below this level right here, the stop loss. Okay, and let me just see if we get that. And that's what happens. Price dips down below. They take all their shares once these guys stop out. And then they load up, they fight. And then the price pushed up, confirmed, and it broke. And then we get our trademark tiny candle body and then a huge impulse. And I say huge, it's on the 1 minute chart. But you can see it's a pretty clean pattern that we can see over and over and over again. It's just trying to figure out who's trying to eat who. So that was the long setup in that scenario. So here we have another liquidity zone. All right, so in this case, we get a push up here, a push down. Maybe that zone's a little big, maybe it's not. Either way, we don't really see the same kind of participation in this one. Remember, it's low volume. We want to see increasing volume, ideally with a tiny candle before the impulse. Like this has a nice tiny candle body, then the impulse. That's institutions. It's high volume right here. Okay, that's what I like to look for. Like right here. Before a lot of these impulses, you're going to see this system right here. You're going to see a little tiny candle, usually a doji or maybe a small hammer candle, and then a huge impulse. Now, when you combine these with being in a zone where people have put their stop losses, that's where the hedgies are. So if you can see those throughout the day, you're going to have a much better time in the market. So right here, for example, okay, this is a level of support. So if I just zoom out, you can see this level was tested as a resistance here, acted as a support here, support, and then it fell, right? So this is the inducement for bullish traders, right? Because they see it tested here, tested here, tested here. It should be a strong level. So once we get a break, they want to push it over. So in this case, if I'm a long trader and I see a confirmation, like let's say I traded this color change right here, my stop loss would be right here. That's a liquidity zone right down here, right below this level. Okay. So if I'm looking for long trades and I'm an institution, I need the price to come down here so I can get filled. Okay, so in this case, it looks like a small buy, you know, maybe a small position because the volume really picked up down here. And that's where you can really tell when the institutions are kicking in. But ultimately, that final buy looks like it was in this area, right? Because you get that small candle. And you can look at all these. Like this is the one that we went through on the stream. You know, if you look at this as an engulf, you know, we've got our engulfing entry here, engulfing stop loss, and then liquidity, right? Did the price come back to this? No. Therefore, they were finished filling at that level. Okay, here you've got that, you've got the stop loss, and then you've got liquidity right below that. Did it come back here? No. Therefore, they didn't need to fill at that level. Then you've got this guy right here. You've got the entry, you've got the stop loss down here, and then you've got liquidity. Did it come back? No. These liquidity zones will still be in place when the price comes back down to this level. But for right now, the one that we were most concerned with was right here. Okay, and it looks like it just went too deep, right? So that invalidates that. It's okay, right? The level itself is still valid historically, but that liquidity zone is compromised. So there's really no There's no confirmation that an institution bought, so we wouldn't have gone long right here, right? It's not a trap in that scenario. When the price comes back up, that zone is already negated, so we don't have to worry about it. What we also have is the opportunity here for the bearish side, right? And this is where, this is, I think, a much cleaner explanation right here. So we've got the opportunity for shorts to kick in right here, right? Knowing that they want to push the price down. We've got an area right here where the buy stops will exist. This is the buy side liquidity zone, meaning that all the people that want to short right here are going to have their stop losses right here, or their buy stops. So if I'm an institution and I want to go short, I'm going to push the price up into here. I'm going to allow it to go up into here. And then I'm going to start to short sell anything that comes into that zone with aggression. Okay. And that's what we got. We tested the zone a little bit. And then we got our combination here. We got that nice angry engulfing candle. And then we got to push to the downside. Now, typically that would hunt this level right here. So we didn't push that. So there's probably some push-pull on the institutional side. So they're just range locking it right now to see what's going on. But we know that on Monday, when we come back to the market, we know where the liquidity is, right? We can see clearly if we look at the 5-minute time frame, we've got a level here, and then a level here. Therefore, longs will have their stop zone, their stops right here. Bears will have their stops up here. Okay, so it might be counterintuitive to look for an opposing direction trade. So for example, if the price comes down here, most people would look for a break and a continuation of the downside. But I like to look for a break and then a buy up to a new high. Okay, and whatever happens to the upside, if the price comes up here, for example, right? Most retail traders would look at that as a break to the upside and want to trade it to the upside, whereas I am just going to wait until I see a hedgy selling, and then I'm going to trade it all the way down to there, right? I want an opposing trade, not a directional trade like we normally look for. And that's because this is the 5-minute chart. If that were on the 4-hour chart, we can see here that the price is moving. Right? If we just zoom out, we can see that Tesla is on a downtrend overall, right? We've got this huge impulse, bearish retrace, it failed, we're pushing down, we got lower lows, lower highs, and then within the shorter context, this gap right here is filled, right? It's resolved, price is pushing back up, we have a fair value gap right here, okay? And we were on our way to filling that today, that's why it couldn't push up to the upside. There's too much liquidity on both sides, all right? So what do we do from here, right? We know that we have the gap. We know that we have bullish price action after the gap is resolved. So we're either going to get a higher high or a lower low. Okay. So in this case, what we're going to look for is a bearish push out of this fair value gap, right? Because we have institutional participation right here. We have the impulse, we have the retrace, and then we want to see continuation to the downside to a new low. This low failed to break this low. Therefore, it is hunted. It has draw. So that tells me on this time frame, the liquidity zones that I'm going to pay attention to are right here to the upside. Okay, so I want to see a push up. I want to see that liquidity get filled, and then I want to see a push to the downside all the way down to below this low. So on Monday, that's the move I'm going to look for. Right there. All right, now I'll leave this up over the weekend, and I'll let you guys kind of study it, but this is what I'll be looking for on Monday. Whether or not that happens, it's not up to me. It's up to whatever institution decides to short sell there. Or if they want to just let it go long, they can do that too. I don't control that. I only control what I believe they are looking for. And I'm basing that on what I know retail traders are looking for. All right. So this is a little bit of a mess. It's a little bit kind of in between. We do also have a gap up here that a lot of retail is probably hopeful that it'll get filled, but that is also an inducement. So it may or may not happen. We have an inverted head and shoulders. Retail is going to want it to go up. Hedgies are going to want to manipulate it to go to the downside to break this low before they allow it to go up. So that's my stance. That's my opinion. Therefore, that's the only trade that I will look to take. And I'm only going to take that on my larger account because this account doesn't have any buying power. So for all intents and purposes, this is all I'm going to be looking for is a push to the upside, a buy side sweep, meaning that they steal everyone's shares from the buy stops and then they short the hell out of it. So this video has been a little bit longer and I'm going to cut it right now. But I just want to make sure that this concept is understood because a lot of retail traders try to buy the way that they're taught to buy and they set their stop losses immediately. That stop loss gets hit and then the price runs in the same direction that they originally intended to trade it. and it's very frustrating. It's a difficult cycle to break. So the reason it's being broken is because the stock market wants to take advantage of your assumptions and impulses. And even if you start to get your charting down and you have healthy risk reward and you use appropriate position sizes, you will be profitable. But if you're constantly struggling and your analysis is something you're confident in, but things just don't seem to work out when it's time to actually execute the trade, even though you followed your plan, it's probably just because you're on the lower time frames and the hedgies are messing you up. So let's break that cycle. Let's take the power away. And more importantly, let's just wait. We're just going to add another step. Ultimately, this is just adding another step in the confirmation phase. If you see a setup, they see the setup. If retail sees the setup, they're the ones that are going to anticipate. They're going to try to get in on these shorter levels. Institutions are going to understand that. They're going to take advantage of that anticipation by letting the price go in the other direction. And then they're going to steal their shares once they panic sell. And then that's when the price is going to start to move in the direction they want it to go. So I'm going to end the recording here. Everyone have a great weekend. Enjoy your Veterans Day and be safe.